Welcome to SS2 Economics, Term 2, Week 5. Today we study the balance of payments, the systematic record of all economic transactions between the residents of a country and the rest of the world during a given period, usually 1 year. The balance of payments is essential for understanding a country's international economic position, whether it is earning more from abroad than it is spending, whether it is borrowing from the rest of the world, and whether it is building up or running down its foreign exchange reserves. For Nigeria, whose economy is highly integrated into the global economy through oil exports, FDI, remittances, and imports, the balance of payments is a central indicator of economic health. The balance of payments has three main components. The current account records transactions in goods, services, primary income, and secondary income. The capital account records transfers of capital, capital transfers and acquisition or disposal of non-produced, non-financial assets. The financial account records transactions in financial assets and liabilities between residents and non-residents. By accounting convention, the balance of payments always balances. Every debit, payment abroad, must be matched by a credit, payment from abroad, because every international transaction has two sides. The current account is the most important for economic analysis. The current account consists of the trade in goods balance, sometimes called the visible balance, exports minus imports of physical goods. If Nigeria exports more goods than it imports, the visible balance is in surplus. The trade in services balance, invisible balance, exports minus imports of services such as tourism, transport, financial services, and education. Nigeria has a persistent deficit in services because Nigerians import many services, including education abroad, shipping, and insurance. Primary income balance, flows of income between countries, wages of cross-border workers, dividends, and interest. Nigerian residents working abroad remit income home, credit, foreign companies repatriate profits from Nigerian operations, debit. Secondary income balance, transfers without exchange of value, remittances from Nigerians in the diaspora, a major credit for Nigeria, and foreign aid received. The current account balance is the sum of the trade in goods balance, trade in services balance, primary income balance, and secondary income balance. If the current account is in surplus, the country earns more from abroad than it spends, it is a net lender to the world. If the current account is in deficit, the country spends more abroad than it earns, it must borrow from the rest of the world or run down its foreign exchange reserves. Nigeria's current account has been driven primarily by oil export earnings. During oil booms, high oil prices, high production, Nigeria typically runs a current account surplus. During oil price crashes or production disruptions, the current account may move into deficit. Nigeria also receives very large remittances from the Nigerian diaspora, estimated at over $20 billion per year, making it one of the top remittance-receiving countries in Africa and among the largest in the world. These diaspora remittances are recorded in the secondary income account and help offset the services and primary income deficits. The trade in services is in persistent deficit because Nigeria has limited capacity to export services and import substantial shipping, insurance, education, and health services. The financial account records changes in financial assets and liabilities. It has three components: foreign direct investment, the FDI, investment in productive capacity such as factories and oil wells, portfolio investment, buying and selling of shares, bonds, and other financial assets, and other investment, including bank loans and deposits. If Nigeria attracts FDI, for example, a foreign oil company investing in a new oil platform, this is a credit in the financial account, money flows in. If Nigerian residents invest abroad, this is a debit. The capital and financial accounts together must balance the current account balance plus capital account balance plus financial account balance plus errors and omissions equals 0. Foreign exchange reserves are the stocks of foreign currencies, primarily US dollars, gold, and special drawing rights, SDRs from the IMF, held by the CBN. Reserves act as a buffer. When the current account is in deficit, reserves can be drawn down to finance the shortfall. When the current account is in surplus, reserves build up. Nigeria's foreign exchange reserves fluctuate widely with oil prices. The CBN uses reserves to stabilize the naira exchange rate and to pay for essential imports during periods of low oil earnings. A persistent current account deficit is a balance of payments problem. It means the country is borrowing more from abroad each year than it is earning, building up foreign debt. Remedies for a BOP deficit: expenditure-reducing policies, deflationary fiscal and monetary policy, reduce domestic demand, including demand for imports. The drawback is recession and unemployment. Expenditure switching policies change the composition of demand from imports to domestically produced goods. Devaluation of the exchange rate makes imports more expensive in domestic currency and exports cheaper in foreign currency, shifting demand. Import controls, tariffs, quotas, import bans directly reduce imports. The effectiveness of devaluation depends on the Marshall-Erner condition. Devaluation improves the current account only if the sum of the price elasticities of demand for exports and imports exceeds 1. In Nigeria, devaluation of the naira has historically not fully corrected the trade deficit, partly because Nigerian exports, oil, are priced in US dollars, so their naira price rises, but foreign demand is not strongly price sensitive, and partly because Nigeria imports goods, refined petroleum, pharmaceutical products, for which domestic substitutes are unavailable in the short term. Supply-side policies, increasing domestic production capacity through infrastructure investment, technology adoption, and agricultural development, are the most sustainable long-term remedy. To summarize, the balance of payments records all transactions between a country and the rest of the world. It has 3 accounts: current, goods, services, primary income, secondary income, capital transfers, and financial, FDI, portfolio, other investment. The current account balance is the most economically significant. Nigeria's current account is driven by oil exports, diaspora remittances, and a services deficit. A current account surplus means the country is a net lender, a deficit means it is a net borrower. Foreign exchange reserves buffer against BOP deficits. Remedies for BOP deficits include expenditure reduction, monetary and fiscal tightening, expenditure switching, devaluation, import controls, and supply-side policies. For WAEC, define balance of payments, name and explain its 3 accounts, explain the current account balance, explain Nigeria's BOP position, and discuss remedies for a BOP deficit.